I want to show you how to value a stock using the present value of free cash flows to the firm, FCFFs. So the value of a stock using we call it a discounted cash flow model or a DCF model is the present value of free cash flows to the firm plus a terminal value minus debt plus cash, or you can think of minus net debt if cash is not needed for operations, and divide all that by current shares outstanding. Now, the terminal value is commonly a growth perpetuity or an EBITDA multiple. So let me show you an example. So you're going to value a stock by estimating sales over the next 5 years and down to free cash flows for the next 5 years. And at the end of the 5th year, you're then going to finish your valuation using a perpetual growth rate from year 6 to infinity. So let me show you this model. So my sales forecast are 1 million the first year. That grows by 20% a year. So I have my sales for all 5 years. I have my COGS as a percentage of sales, my SG&A as a percentage of sales, my depreciation as a percentage of sales. I then have EBIT, taxes, and that'll give me EBIT after tax. And then I can just go from EBIT after tax to FCFS by adding depreciation back, subtracting CapEx, which in this case is assumed to be 12% of sales, and then subtracting changes in net working capital. In this example, net working capital, say it just paid yesterday, we'll say, or the working capital balance yesterday was 66,000, and then it's just some percentage of sales in the future years. So these are my non-cash net working capital numbers here. I only need the last one to get the change, so minus the change in net working capital for each year. And then if I add from EBIT after tax, and add depreciation, subtract CapEx, subtract changes in net working capital. These are my unlevered free cash flows, or FCFFs. So this is the cash flows for year 1, 2, 3, 4, 5. And then we assume that cash flows grow forever at 3%. So I can take the year 5 cash flow times 1 plus the perpetual growth rate. That'll be the year 6 cash flow. So again, the year 5 cash flow times 1 times perpetual growth rate is the year 6 cash flow. Divide that by R minus G to give me a perpetuity. That is the value of the cash flows from year 6 to infinity. And remember, the perpetuity formula always gives you the value the year before the cash flow. So this is the value of the cash flows from 6 to infinity, discounted back to year 5, which then allows me to add that, we call it a terminal value, to the year 5 cash flows. So there are my year 5 FCFS plus my terminal value. Now, to value the stock, I'll take the net present value, or the present value of all future cash flows from year 1 to infinity. Remember, you have cash flows from 1, 2, 3, 4, 5, and then this captures the cash flows from 6 to infinity. So that net present value, which we call of the FCFFs, we call that the enterprise value. It's how much you pay for the assets of the firm. If I then subtract off net debt, because cash is not needed for operations, so I subtract debt, add cash, divide by the number of shares outstanding. Remember, for debt and cash, it's the current value, so period 0, debt and cash in this example, and divide by current number of shares outstanding. So this should be a $74 stock. Now, I just repeated this example here, and the only thing I'm going to change is I'm going to replace this terminal value with a different assumption. So to finish the evaluations, what we say in this model here, it has a 5-year detailed estimation window. And then at the end of the 5th year, we make an assumption about the value of the company. In this case, it's a growth perpetuity. We're going to repeat the exercise here from above, but the only difference is I'm going to make a different assumption. So I basically delete this assumption here about growth perpetuity, and I'll replace it with this assumption that there's an EBITDA multiple, that companies of this characteristics you've determined are worth about 8 times EBITDA. So all these numbers here are exactly the same as above. This is just the addition from above. The only difference is I've calculated EBITDA in year 5, which is just sales minus COGS minus SG&A, earnings before interest, taxes, depreciation, and amortization. And then I can just multiply 8 times EBITDA. And that's another way of finishing off the valuation. I can then put that, and including in my terminal value. So the way I think about this model is the value of the company is the present value of the cash flows from 1, 2, 3, 4, 5. And then I determine at the end of year 5, this company should be worth 8 times EBITDA. And then I just take the net present value of those numbers as I did before. I subtract out net debt as I did before. And I can then divide by number of shares as I did before. So this looks a lot like the model, I believe is in problem number F, or letter F in the current assignment. So sorry for not giving you an example like this. I'm going to add this to future lectures to give you a guidepost or a kind of a model to base that on. So good luck and talk to you soon.